Let us continue with question and answer series. Asif is a resident of both India and another foreign country in the previous year 2021. This is possible that one person can be resident of two countries, and for that we are having a proper, please understand, in interpretation of tax treaties we are having a whole cycle. What steps we have to follow to understand exactly in which country we will consider him as a resident. That DTAA component is also provided in this question. Initially they will say, yeah, he is a resident of both the country, but it cannot happen that global income is becoming taxable in India as well as global income is becoming taxable in foreign country. Then this guy will commit suicide. You understand? He can't pay tax on global income in both the countries. Therefore, we have to finalize which is the final country who will take the tax, or exactly how much income will be taxable in India, so far as India is concerned. He owns immobile properties including residential house in both the countries. So look at the confusion. He is a resident of both the countries. He is having house also in both the countries. He earned income of 50 lakh from the rubber estate in the foreign country during the financial year 2021. So foreign income 50 lakh. He also sold some house property situated in a foreign country, resulting in a short-term capital gain of 10 lakh during the year. Asif has no establishment of a business carried on in India. This is very, very important. He does not have any business establishment in India. He is having house, but he is not having establishment in India. And if somebody is earning 50 lakh rupees and capital gain, meaning thereby he must be having business establishment in a foreign country. This line is very much important line. This is the deciding line, my dear friend. However, he has derived a rental income 6 lakh rupees from a property let out in India, and he has house in Lucknow where he stays during his visit in India. So looks like whenever he comes to India, he stays in Lucknow and he is not earning any active or passive income. He is earning rental income from India. So this is Indian income. Okay. Article 4 of Double Taxation Avoidance Agreement between India and the foreign country where Asif is the resident, provide that where individual is a resident of both the contracting state, then he shall be deemed to be the resident of the contracting state in which he has a permanent home available to him. Now problem here is that India is also here, he is having permanent home in India as well as he is having permanent home in foreign country. So this is not giving us any clarity. If he is having permanent home in both the contracting state, then he shall be deemed to be resident of the contracting state with which his personal and economic relations are closer. That is center of vital interest. Looks like with the data given in the question, though he is having permanent establishment in both the country, in a foreign country he is having more vital interest. Okay. You are required to examine with the reason whether the business income of Asif arising in a foreign country and capital gain on the sale of the foreign country, okay, can be taxed in India. They are asking, can it become taxed in India? Answer should be no, because he looks like a resident of a foreign country. Let's look at the presentation. Section 90 provide that where central government has entered into an agreement with the government of other country for granting relief for a tax or for avoidance of double taxation, then in relation to assessee to whom such agreement applies, the provision of income tax shall apply to the extent they are more beneficial to the assessee. This is the plain law, section 90. In this case, Asif is the resident of both India and foreign country. Therefore, DTAA provide for the tiebreaker rule. We call it tiebreaker rule. If the person is a resident of the two countries, he shall be deemed to be the resident of the contracting state in which he is having permanent home available to him. And if he is having permanent available home in both the countries, then center of vital interest, that is economical relation and personal relation, we have to check. And looks like he is having vital interest in the foreign country. Asif having residential house both in India and foreign country, thus he is having permanent home in both the countries. Asif owns a rubber estate in a foreign country from which he derives a business income. However, Asif has no permanent establishment in India. Therefore, his personal and economic relations with a foreign country are closer, since the foreign country is a place where he has a property, okay, and permanent establishment set up. Okay. Therefore, he shall be deemed to be a resident of a foreign country for AY 21-22. This is according to tiebreaker rule. You know, according to the Supreme Court case, DTAA provisions prevails over Indian income tax law. Accordingly, only income accruing and arising or deemed to accrue or arise in India shall be taxable in India in the hands of Asif. However, yes, the one condition we have to write, if he has to take the benefit of section 90, then he has to give us tax residency certificate from foreign government. Further, he has to provide some additional information, as we have discussed. He has to give us, his legal status, his residential status, how many days he stayed outside India in that particular country, his permanent address of that particular country, his tax identification number or unique identification number, and all these information are not required if it is already mentioned in TRC. Therefore, in this case, Asif is not liable to income tax in India for AY 21-22 in respect of business income and capital gain which he has earned in a foreign country. Only Indian income will become taxable, foreign income not taxable. Next question is very important question. Please mark it important, because here you are going to learn a complicated calculations of Indian income and foreign income. See, rules for Indian income is different and rules for foreign incomes are different, and therefore whatever questions on section 91 we have solved so far, the doubly tax income was common in both the countries. But from this question onwards, the doubly tax income in both the countries may not be common. Mr. Kamlesh, an individual resident age 52 years, furnishes you the following particulars of income earned in India, country X and country Y. Now look at this. Kamlesh is not only earning income in India, he is earning in country X and country Y. That means this is a question of two different foreign countries. India has not entered into double taxation avoidance agreement with these two countries. We don't have DTAA, meaning thereby section 91 will come into play. Income from profession carried out in India, definitely taxable. Agriculture income in country X, gross. Obviously, foreign agriculture income is taxable in India according to Indian income tax law. Dividend income received from company incorporated Y. Foreign dividend is also taxable in India. This is also foreign agriculture income is also taxable. I'm just thinking about Indian taxation. Okay. Royalty income from a literary book from a country X, gross. So royalty income, but whenever royalty income comes, you should think about 80 QQB, 3 lakh rupees deduction. Expenses for incurred in for earning this royalty income 50,000, we will provide deduction under section 57 IFOS. Business loss in a country Y, business loss. Can I set off business loss against Indian business income, or if we have to talk about country Y, then any income that we are earning, house property income that we are earning in country Y, definitely yes, you can set off. Business loss can be set off against house property, capital gain, other sources, but cannot be set off against salary. Rent, not income, rent from the house property situated in country Y. Whenever rent has come, we have to think about 30% standard deduction in India. Municipal tax paid in respect of the house in country Y, not allowed as a deduction in country Y. Okay, country Y does not have any provision of giving you deduction of municipal tax, but government of India provides you deduction, and we are having a Supreme Court judgment of Venugopala Reddy in IFHP head, which says any tax paid to the foreign country or foreign local authority when you are having a house property located in that local authority should be allowed as a deduction. So in India this will be allowed. Foreign country may not give us, but India will give you deduction while computing income in India. Note, business loss in country Y is not eligible for set off against other income of as per the law of that country. This is to confuse you. India provide deduction of business loss against house property, no problem at all. Yeah, when you compute income of that country, you should not, when you are computing foreign income and foreign rate of tax, that time you should not consider this set off. The tax rates in country X is 10% and country Y is 20% respectively. Compute the total income and tax payable by Mr. Kamlesh in India for AY 21-22, assuming that he has not opted for 115 BSE. Easy question, just they are trying to confuse us and there are too much data available here. So income from house property situated in country Y, okay. Gross total income 2,40,000. We will provide deduction. Please understand, we will provide deduction of municipal tax. So net annual value 2,30,000. Standard deduction also we will provide. There is no mention of standard deduction, but you know that whenever we compute IFHP in India, we always provide 30% standard deduction. So taxable income is 1,61,000. There is a profit on business from Indian business, that is 7,50,000. Royalty income, net royalty income 5,50,000. Business loss is 65,000, that we have to set off. Please understand, that country does not allow, but our country will allow. So income from other sources, agriculture income 50,000 and dividend income another 1,50,000. Total other sources income 2 lakh rupees. So gross total income 15,96,000. We don't have any data of chapter 6A deduction, but 80 QQB we will provide. That is a deemed adjustment, by default adjustment you have to provide on whenever you are having a royalty income, maximum rupees 3 lakh. So net total income is 12,96,000. Many students will forget to provide 80 QQB, but whenever royalty comes, by default 80 QQB should come to your mind. Compute the tax on 12 lakh, the total income at the rate of 30% on 2,96,000 and then 1,12,500. That is 2,01,300. Then health and education says the total income tax will be 2,09,352. But now we have to provide relief under section 91, and relief is computed in working note, and we have to compute in working note. It's not easy like earlier time, because here two countries are there and they have not provided us a single income which is doubly taxed. Okay, there are multiple income and then there will be net tax payable. Tax payable will be rounded off in a multiple of 10 rupees. That concept was also used in this question. Look at the working note. For country X, first of all, average rate of tax in India 16.154. This we have to compute by dividing total income tax divided by total income in India. Average rate of tax in country X 10% given in the question. So what is the doubly tax income then? Agriculture income 5 lakh rupees and royalty income. Royalty income, that country provide deduction for, please understand, that country does not provide deduction for any other expense, or we don't know, but India provide expenses deduction and 3 lakh rupees. So doubly tax income is not 6 lakh rupees. Many students take 6 lakh rupees as a doubly tax income, but please mark my word, my dear friend, in that country 6 lakh might have become taxable, but in our country 6 lakh was not taxable, only 2,50,000 was taxable. This is also very, very important point. Yeah, though we have earned 6 lakh rupees, but 50,000 direct deduction and 3 lakh rupee deduction under 80 QQB. So doubly tax income is only 2,50,000. Okay, so doubly tax income is 3 lakh. So 10, whichever is lower, obviously we have to provide. So 3 lakh into 10%, 30,000 is the relief for country X. Now for country Y, average rate of tax is 20%. Let's look at the doubly tax income. Income from house property in India 1,61,000. Doubly tax income you have to compute as per India. Dividend 1,50,000. Okay. Business set off we will provide because India provides set off. So doubly tax income in India was 2,46,000 only. So this doubly tax income is very, very important adjustment of this question. So you know the tax rate of India, average rate of tax was 16.154, and here the average rate of tax is 20%, whichever is lower is 16.154. On a doubly tax you have to apply this rate, and this is the total amount of relief that you will get under this particular question. Yeah, please practice this question one more time, and you know that whenever section 91 comes, we have to write this basic condition, that he is a resident in India, he is not the income is not deemed to be accrued in India. So all those conditions you have to write. Please write those conditions and conclude your answer. Thank you.